Okay, hello everyone, and welcome to our update on the Baillie Gifford UK Growth Trust. My name is Kathleen Hunter. I'm a client director at Baillie Gifford, and today I'm joined by Iain McCombie and Mileva, who are both partners at Baillie Gifford and co-managers of our UK Growth Trust. Our plan today is to have a 20 to 30 minute discussion on the recent drivers of performance, our key areas of enthusiasm, and the reasons why we remain confident in the outlook for the portfolio. We'll then move on to a 15-minute Q&A where we'll answer some of the questions that have already been submitted prior to the webinar. And if you would like to ask any other questions throughout our webinar, please do just use the Q&A panel at the bottom of your screen. So to kick us off, Iain, could you please briefly remind us what your investment philosophy is and why you believe in it?
Yeah, sure, Kathleen. Well, good afternoon, everyone. I think if you know Baillie Gifford, then this is probably not going to be a big surprise to you. But the three key tenets are that we're active, we're long-term, and we're growth. But let me put that in the context of the UK Growth Trust. So when I mean active, we want to be very different from the index, and we have an active share of about 85%, which is very high for the UK market because of its concentrated index. And we think that's the best way to generate long-term returns by doing something different, from the benchmark, and believe in the stocks that you own. And then we're also long-term. Now, when we identify companies that Milena and I have think are in that portfolio, we have about just over 40 stocks in the portfolio. We want to run them for as long as possible because we want to have those superior fundamentals working for you. And actually, since we've taken over the mandate, our portfolio turnover has remained very low, at well below 10%, which is consistent with our long-term patient approach. And the last thing is that we're growth investors. We think there are lots of opportunities for growth investing. I'm sure we'll come on to that later in the webinar. But the nutshell is, we are trying to find individual companies with superior growth rates to the market over the long term, and we want to own them for as long as possible. And I think this slide is actually really quite useful in terms of making this point that, share prices follow fundamentals. And what this does here is shows the UK market split into quintiles in terms of growth. And what you can see on the right-hand side is that the fastest growing businesses perform the best. And this is very consistent whether you do it globally or in the US or in Europe, but also in the UK. So we think this is very much an underpinning to what we're trying to do.
Great, thank you very much for that introduction to our philosophy. Now, moving on to performance. So since taking over the management of the trust about 5 years ago, performance has been disappointing. So I think it would be worth just delving into what's happened here and why our investment approach hasn't worked recently.
Yep. As you say, Kathleen, we took over the management of BG UK in the middle of 2018. And for the first couple of years in 2019 and 2020, we were actually off to a pretty good start with the portfolio outperforming the broader UK equity index. But the last 2 years have been significantly more challenging with as you can see here, with 2022 being an especially poor year for our relative performance. And I think to summarize that, there's two key reasons as far as we can see that is that the macroeconomic backdrop following the end of the pandemic and supply chain disruptions and the war in Ukraine, with interest rates rising very sharply everywhere, has been by far the most dominant influence on investment outcomes over this brief period, and it has been an environment which has been not very conducive to our growth investment style, with interest rates rising very, very rapidly in the market, kind of trying to work out through the imperative of discounting at the higher rates. I think both Iain and I have been very upfront with shareholders since the beginning that we have a very pronounced growth bias and we don't expect to outperform in all environments. And I guess we have been in an environment where just any long duration growth company has been hit quite indiscriminately, regardless of any fundamental operational progress which might have been made. As Iain alluded earlier on, of course, our index is very concentrated, and some of the large index constituents, the resource companies, energy companies, and banks have been beneficiaries of the macro over the last couple of years. We remain of the view that these are short-term cyclical tailwinds, but these companies will not be able to grow at above average market rates for in terms of our investment time horizon. So we remain comfortable with not owning them, but they've certainly been a headwind to our relative performance.
Okay, thanks for that. So our style of long-term growth investing has definitely been out of favour. However, some people in the audience might be asking, could we have done anything differently to reduce the magnitude of losses?
Yeah, I mean, that's something that we've been asking ourselves, and also the board have been asking ourselves. So they really asked us to kind of to do some work on this. And what we did, we worked with our risk team at Baillie Gifford to look at kind of various scenarios which we think are plausible scenarios. And what we looked at, for example, is if we'd equally weighted the portfolio, if we'd capped our holdings at 4% in the portfolio. And actually, I think perhaps the most interesting one is if we'd actually sold or reduced some of our most, with retrospect and with hindsight, the most overvalued stocks and reinvested them back into the portfolio, which is a kind of credible thing. And I'll come back to that in a second. But we think that's a kind of a realistic scenario to keep investing in growth because, as I said, and Milena also said, we are strongly growth investors. And what the numbers show is, has it made much difference? Not really. So therefore, what do we conclude from that? Well, really, it's been a style thing that as Milena had said, the evidence seems to back that up, and therefore we don't think it's something we could have done. Now, obviously, the other question is, well, you could have bought other things that have done well, but these are value stocks. So it's been us buying things like Shell, BP, HSBC, that sure, they would have outperformed if you'd had that perfect hindsight, but then we'd have been accused of style drift. That'd be very much against our philosophy of buying companies that we don't believe have long-term attractive growth fundamentals. So we think that, it's been uncomfortable and unfortunate, but we still believe in our portfolio, and we think that it's really been a style thing that's been really against us there.
Okay, thank you for that. That's helpful. However, has there actually, in addition to that, been any sort of individual stock mistakes during that period?
Well, Kathleen, the short answer is yes, of course. I mean, the reality of all fund managers, but particularly with growth investment style, is you're going to make mistakes. Companies you think have got really interesting growth potential, and for either internal reasons or external reasons, they don't kind of match that potential. And yes, we've had some of those. Now, there are two questions that we've looked at. One is, have we been making more mistakes than normal in that respect? Because you're always making mistakes, and the dirty secret of fund management is that when things are going well, nobody cares about it. But when things are not going so well, everybody kind of rightly focuses on that. But we don't think that's the case. The second thing, which I think is interesting, is we looked at all the sales that we've made since we took over the mandate, more really from a business analysis point of view. And what was interesting in that respect is of all the things that we sold, all but one have actually underperformed. So what that tells us is that it gives us some confidence that in terms of our analysis of businesses, we don't think what we're trying to do is broken, that we can identify when something's not working and we can do something about it and we sell it, and the vice versa, that things we like are still attractive. So that kind of gives us some confidence, but definitely we're not hiding from the fact that we have made mistakes.
Okay, thank you. No, that's really helpful context for understanding what's happened over the past few years. Now, if we shift gears slightly from here and look ahead, why do you think the trust looks attractive today, either for existing or, new investors? Milena, I wonder if you could take that.
Yeah, no, gladly. I mean, I think the key reason for that, Kathleen, is really the chart that Iain chatted over in the beginning of the webinar here, which is over a meaningful time frame. We do believe that share prices ultimately follow fundamentals, and the fundamentals of our portfolio in terms of its growth, in terms of its quality and resilience, are more attractive than that of the average company. And importantly, I think we believe strongly that these fundamentals are sustainable, which is important because we invest over long periods of time. So we think over time this gets rewarded and recognized in superior share price performance. And I think that's the reason that, we've been through a very turbulent period for our investment returns. But as Iain said, our portfolio turnover has remained exceptionally low. I think I was looking at the data of the 15 top detractors to our performance since we've taken on the trust. We are invested in 11 of those companies still. So I think that should be taken as a strong confidence in these companies and in their underlying growth potential. And I really want to stress this point to our shareholders, because I don't think it should be taken as complacency or just kind of blinker devotion and rabbit in the headlights type thing in the context of a difficult performance period. There's been a very deliberate process which underpins this conviction that the long-term potential of our holdings remains unrecognized and substantial. And one of the evolutions we've made to our process over the recent years is that we've been going out on the road a lot, visiting our companies at their offices, and we've been spending, a good part of a whole day, 6, 7, 8 hours on average with individual holdings. And we really think that type of interaction and engagement is allowing us to kind of calibrate and understand the long-term risks and opportunities for our companies in a much greater degree of depth and nuance than it would have been possible in the past, and really hopefully to drive the appropriate behavioral responses to those investments. So it's something we intend to continue doing on an annual basis going forward with our individual investments. And I think here we've just given the slide that you're sharing currently. We've just given the flavor of some of the holdings that we think are just very exciting growth investments in the UK. It's again, I think, stressing the point that they are quite an eclectic bunch. They come from different industries, different business models. I think that's quite important as bottom-up stock pickers. Our job is really to uncover the individual strengths and unique characteristics of companies, and which will be very powerful over the long term, but might not be recognized by the market in the short term. And I think that's what we're trying to do. There's sometimes this equating of growth investing with technology investing, which we think is not is misguided and one-dimensional. Growth companies can come in all shapes and sizes, and our portfolio is hopefully reflective of that fact. We have long-term holdings here like AutoTrader and Experian and Ashtead, where we are really enthused, even though we've held them for many years, that actually the potential here is now bigger than it was when we first invested. Their competitive positions with scale have become actually a lot more entrenched over the years. I think all of them, we can argue the addressable opportunities they have are bigger than they were when we first invested in them. So we remain very enthused. There's companies like we've spoken about in the past to shareholders like Renishaw and Genus, where we just think there's just been a wealth of IP, which is compelling and has been developed on the back of very long-standing investment in research and development. And it's not properly recognized by the market, often for cyclical issues, which kind of obscure the longer-term earnings power. And we have some much younger, earlier stage companies like Wave and Creel Medical and Oxford Nanopore. They're small holdings in the trust, but we like to see them as seeds for the future. These are companies that are really at the vanguard of pretty breakthrough innovation, and hopefully their progress will get realized over time, even if it might not be done in a very linear fashion. And we have companies like Games Workshop and Foreign Print that we've been invested in a long time, and again, they're ones where very much the confidence in the management team and the stewardship of the companies is one of the key reasons why we think the businesses will continue to be very successful over the next 10 years and beyond. So hopefully a good spread of ideas that we remain enthused about, and in many cases have been adding over the last couple of years on the back of share price weakness.
Great. Yeah, it sounds like a very eclectic mix of really interesting businesses.
Yes.
So you also just mentioned that turnover has been pretty low over the past few years, but would you be able to give us a couple of examples of where you have made any changes to the portfolio?
Yeah, I think in terms of new buys and additions, I think the thing to emphasize is that a lot of our activity has really been in the existing portfolios for the reasons that we've just kind of gone over. We remain very strongly convinced that these companies are undervalued. And we've been leaning into share price weakness, especially in cases, I think, where there's been also short-term cyclical issues which have kind of clouded the longer-term attractions. And great examples here would be Kainos, Genus, AJ Bell. Those are companies where we really think strong fundamentals long-term, but there's been some cyclical issues that have somewhat obscured the long-term earnings power. So we've been adding to those. We haven't made a huge amount of new purchases. There was only one new buy over the last year, which was the online card retailer Moonpig. It's a company which listed in 2021, and we were not involved in it, but we noted it as a potentially quite attractive long-term growth company, and we subsequently invested in it in the end of last year because we think it's again one of those companies. It was a beneficiary of the COVID period, and the shares have struggled a lot in the aftermath of the pandemic, partly as the COVID unwind has taken place, but also because clearly people worried about consumer discretionary spend. But equally, this company has very appealing structural features. It has a large base of, we think, potentially very valuable customers. It's investing a lot in data science. And we think that would hopefully drive significant value creation from that very large existing customer base. So we've taken an opportunity of share price weakness then and purchased it for the trust.
Great, thank you. Well, sticking with stocks, earlier on, Iain, you mentioned that this is a really concentrated, high conviction portfolio. You've only got 41 stocks in the portfolio at the moment. What are your biggest positions and why?
Sure. Well, our biggest three holdings are AutoTrader, Experian, and Games Workshop. And they're all over 5% kind of holdings. Now, I think Milena kind of talked a little bit about all of them kind of earlier. But the thing what I would want to stress here is the growth mindset of the management teams, and the fact that they're all eclectic. They're not just technology businesses. They're quite different, but they have that growth mindset, and they're looking for ways to expand their markets. So, for example, something like AutoTrader, a lot of people on the call will know AutoTrader. They probably just think of it as a kind of, that's where you can look for secondhand cars, and it does a fantastic job there. It's the dominant player in that market. But what we've been really interested in is how they've been looking at how they can build on that fantastic position. Get involved in the chain of a customer wanting to buy, wanting to get finance for it, and helping that can be one of the sticking points. And taking a little bit of a cut out of that, and that's kind of interesting. It could be involved in new cars, because as the UK market is evolving there, that the way you buy cars is changing. Now, we don't know where that could work, but they're on it. They're looking at that, and that's the kind of thing that Milena and I really like, is companies that are being thoughtful, disciplined, and trying to invest in the future. And to me, it's always this kind of underlying there's not interesting companies in the UK, and these are three fantastic examples of companies with really strong IP, really strong competitive positions. Particularly something like Games Workshop, it's unique. There really isn't anything like it. But Experian is a world leader in what it's doing, and AutoTrader is a really dominant player in the UK. So that's why they're they're big positions, they're very profitable, they've got great growth prospects, and we're very happy with them.
Great, thank you for that. Well, the final question for me before we move on to questions from the audience, would you be able to briefly summarise very simply why you're confident that the portfolio will be able to outperform over the long term?
Yeah, I think we have been consistent in executing our process. We've been evolving it and making it better, as we always should, but we're sticking with it. We think it has the capacity to add value over the long term, and we think the portfolio is frankly populated with some very attractive long-term growth investments, and that potential is just not recognized. So we will remain quite patient and steadfast into owning them and see that through.
Great. Well, so now we'll move on to the questions that we've received from the audience in advance of the webinar. So the first one that's come in is very topical. So given the upcoming UK election next week, someone has asked, what impact do you expect to see from the UK election?
Okay, I'll probably take that one. Well, I'm obviously not betting on it because that's a bit too topical at the moment. But look, I mean, we're bottom-up investors, and actually, if you look at the data, it would suggest that whether it's Labour or Conservative, there's not a huge difference in terms of the kind of the long-term economic growth. So actually, it might not make a huge difference, you know, to us. But I don't want to kind of give the impression that we don't think about this or we don't care about it. You know, for example, so there's a holding we don't own in a trust, but we own it elsewhere, a company called Trainline. I'm sure people will know about it. And we have spent a lot of time, you know, thinking about that and whether, you know, could they be, you know, how are they going to be positioned if there's a change of government and some of the statements that we've done. So, you know, we do look at these things, but I don't think it's, when we look at the portfolio in the trust, you know, we've looked at it and, you know, it's hard to say there's something there that we're particularly worried about with, you know, with a change in government. And you know what, it could be a positive thing. You know, if people, you know, I think there's a feeling, you know, that there's been a bit of a sort of waiting for something to happen. What's the catalyst? Well, you know, maybe a change of government and you know, the emphasis on growth. You know, wanting to kind of grow the pie, which you know certainly the opposition are talking about, you know, that's not necessarily a bad thing for growth investing. So, you know, we'll have to see, but, you know, we're very comfortable with the portfolio as it is at the moment.
Okay, thank you. Another question's come in. So has there been any impact on UK equities due to China-US trade wars?
I don't think there are huge vulnerabilities in our portfolio to escalations of these trade tensions. I mean, in fact, there probably is an opportunity for some of our holdings. As you know, it's not just a reflection of China and the US. It's just generally after the pandemic, people are a lot more countries are a lot more concerned around supply chain resilience and self-sufficiency, and that is creating opportunities. I mean, companies like Arstead, for example, are benefiting in the US from the growth of big projects around you know, semiconductor fabs and big construction projects like this, which obviously the US is quite keen on doing to in response to the Chinese trade tensions. You know, again, any investments in automation that come on the back of those types of things, again, it's probably good for companies like Renishaw. Yeah, I mean, I think there's opportunities. In some cases, some of our companies might have been competing against Chinese indigenous competitors. The potential for these competitors to make big dents abroad is probably now less likely than it was. And then I suppose there's always some negatives around it. I mean, I guess Prudential would be probably one holding which obviously has been affected by Chinese and US trade tensions. Though obviously the operational performance of the company has not been, but clearly it's weighed on sentiment. But on the whole, we don't think we are exposed to any significant escalation there.
Okay, thank you. Another question, sort of referring back to, I suppose, some of the earlier discussion. So in an uncertain economic world, whatever the next big event might be that could cause another spike in interest rates, what would we do differently to avoid underperformance if we're unwilling to drift from our, long-term growth investment style?
That's an interesting question. I mean, it's hard to give a definitive answer to that. I mean, what we're not going to do is style drift. And also what we're trying to do is to own companies for the long term. And as I think Milena, very eloquently said earlier, we're not going to outperform in all markets. We're not an all-weather fund. We're very much a growth fund. And higher interest rates and rates going up is not good news for growth investing. That is a kind of, as we've seen in the last kind of couple of years, we've had companies that have very good operational performance, but the share prices haven't done very well because people are saying that in the short term we don't like growth businesses, and we think that'll come good, but you have to be patient. So we're not traders, and I think Milena and I would be the first people to say that it's not as simple as saying, oh well, we could sell something and come back to it, because actually it's hard enough to actually find attractive businesses. But then you're saying you're so skillful that you can sell it and you can come back and time it perfectly to get back into it again. And I think Milena and I, as kind of warriors, would always kind of worry that you might do one well, but you might do the wrong one. You might not buy it back in time, and therefore you look pretty stupid. So what we have tried to do, and we think this is the beauty of the kind of the closed-ended structure of investment trusts, is identify the 40 most attractive names that we can and try to own them for as long as we can, and not to get distracted from that. We think that's the really key thing. Now, if you thought interest rates are going to go up, something bad had happened, I'm sure we would look at that portfolio, and we always keep testing resilience of our portfolio. So we're not saying we do anything, but we do it on a case by case kind of basis, I think.
Great. Okay, thank you. So another question that's come in. So you appear confident in the future, but what are you most worried about? I'm sure there must be something.
Yeah, I mean, we're always worried about getting the investment analysis part wrong. That's what we would always be worried about, and that's what we try to get better at all the time. Because that's kind of bread and butter. So whilst Iain's saying mistakes will always happen, we try our best to be as robust and rigorous in the analytical side of things to avoid it, and to buy companies that are genuinely of that exceptional quality, where you can be relaxed about owning them over long periods of time, because their competitive positions are very strong, and they're basically run by people you trust. So I think that's the key one for us, is making mistakes on that basis that we would worry, that I would personally worry about.
I think, I agree with that. I mean, two other things for me. One is to kind of we're very aware that, that shareholders have had a really tough period in the last kind of couple of years. And you do worry, we don't want to sound as though we don't care, or, we're not being really thoughtful about it. We care really a lot about it. And as Milena said, we've kicked the tires on our process. We've seen things we can improve in that. So we're not sitting here being complacent or arrogant about it. So you always worry that people are saying you've got to do something, or you're not doing something. We think we've done the appropriate things to position ourselves to kind of to deliver better performance in the future, and but we think the core of what we're trying to do is unchanged. But as Milena said rightly, we can always get better, and hopefully we're trying to do that. And on the portfolio itself, I think the other thing I guess we worry about is just we all know the UK has been a little bit out of favor. Opportunistic M&A, the fact that people will kind of come in and potentially offer bids for companies that we think actually undervalue the long-term potential. And we've seen a little bit of that in the portfolio in the last 2 or 3 years of I guess what is it, Abcam, HomeServe, and Euromoney, Ultra Electronics over the frankly, businesses we'd all been quite happy to keep owning, because I think they're all really good businesses. But the reality is that bids came in, shareholders wanted to sell, boards wanted to sell, So that's something you worry about, and we're starting to see a little bit more of that with kind of a few household names starting to happen there. In one sense, it's good, the fact that you kind of, it backs up the fact that at least you're owning attractive businesses, but we want to own them for a long period of time, and not to kind of just take the money and run for a 20% uplift.
Great. Okay, thank you. Got a couple of stock specific questions. First one, just to try and understand what prompted the decision to reduce our position in Rio Tinto.
Yeah, I mean, I'll take that one. I see Milena's want to say you can do that one. Look, I mean, we like Rio Tinto. It's a very strong position in iron ore and in copper, but it's a behemoth. It's a decent business. It's not the most exciting kind of business, and really we've used it a little bit at times as a kind of source of funds to add to things that we think have actually got more potentially more exciting kind of growth potential. And I think that's the kind of thing about the portfolio we will kind of come across is we're very agnostic about the types of growth. We like fast growing businesses, we like emerging growth businesses, and we like kind of steady growth businesses, and we also have cyclical growth businesses. And I think kind of Rio is probably one of those ones that's a kind of a bit cyclical. It's done quite well, and what we've been identifying more recently in the kind of market where kind of growth has been kind of derated is they're more attractive, very attractive businesses have been derated, and we've seen that as an opportunity to kind of to add to things. Something like Kainos is a great example of that, where company we've really liked for a long period of time. We waited, we were patient, and we've been rewarded with that because the opportunities come, and we've been adding to it and building into kind of a pretty decent position in the fund. So that's part of that was funded from Rio Tinto, for example.
Okay, great. Another one on Bodycote this time. So it's just with regards to the recent change in CEO. Could this be a catalyst for future growth?
I'm not sure on that one in particular. I mean, I think it's been well run for a number of years. I mean, I think if there's any people on the call who remember Bodycote of 15 years ago, it's a very, very different business. It used to be a pretty crappy business with very cyclical and low margins, and I think the outgoing CEO did a really good job of turning that around. So I think the new CEO coming in has got a really great platform, for the future. But I don't think it's as much about the CEO. It's just about the operational business and the work, the environment. It's got very good positions in things like aerospace and automotive, EVs and so on. It's got a lot of opportunities, but it is cyclical. So there's kind of things going on at the moment. It's doing okay, but I think it's really well positioned, for the future. And they've made no, and this is a world-leading business. It's one of the biggest players of scale in the heat treatment area. There's really nobody else, and a lot of its main competition is actually in-house. And actually with ESG and so on, is actually much better for you to do it through Bodycote than do it yourself. So I think there's lots of opportunities for Bodycote. We've met the new CEO, but it's very early days. We'll have to see what he says. But certainly there's no sign there's going to be any kind of big change in what's going on in the last few years, and we're pretty comfortable with that.
Okay, thank you. One other stocks question that's come through, sort of a similar theme with regards to your views on, management, this time at St James's Place.
Yeah, I mean that's an interesting one. I mean, look, it's been one of our poor performing kind of stocks, and I think people in on the call are very well aware of that. And I won't kind of insult people by saying what's happened. I mean, we know the new CEO from his days at Prudential. We think he's very good, and in a way, it's been pretty much a baptism of fire for him. But in a way, I think he's very determined to kind of get to the bottom of it and move on. And we'll see. There's obviously kind of regulatory uncertainty on that. But to me, he's trying to do the right things, and we will wait to see. He's got a review coming up with interim results as to any kind of further changes he wants to bring in. But I think he's bringing in energy, somebody coming in from the outside. He's reiterated to me a number of times that he thinks this is a growth business and a growth opportunity there. So we'll see, and that's while we're sticking with it, there's a lot of uncertainty there at the moment, but the valuation arguably might be capturing that. So.
Okay, thank you.
I think, Kathleen, just a slightly bigger context, we have been debating just the overall space. We have exposures in few areas there, as you know, and have had for many years. So we've been actively debating the extent to which the industry backdrop might be becoming less compelling over the next 5 to 10 years. I mean, we know there's a lot of very attractive long-term drivers for the UK savings market, but there's also other things going on around regulation and competition, and we're just trying to debate the overall space and be quite selective about our exposures.
Okay, thank you. So the final question which we've had through, as companies stay private for longer, someone has asked if the UK Growth Trust can invest in private companies.
Yes, we can. It's a short answer. Up to 10% of assets can be invested in private companies. We only have one investment we've made so far. We've always said that we are looking for things that are genuinely additive to public investments that we can't get anywhere else. And here's the advantage of the investment trust structure. Because as the question suggests, it's a trend not just in the UK, everywhere in the world, that companies are staying private for longer. We've only made one investment in a company called Wave, which is an autonomous driving company, and we'll continue to look for other very additive investments in this area. But we are being quite thoughtful and cautious about the way we do it. We only want to choose very, very attractive, exceptional opportunities.
Great. Well, thank you very much, Iain and Milena, for your time today. And thank you everyone for joining us and for all of your questions. We hope that was useful.